Hey everyone, this is John Feneck with the Feneck Commodities Report, and with me today is my podcast partner, Don Durrett, founder of goldstockdata.com. Don, how are you?
Great, John. Ready for the new year.
Yeah, this is our first one in 2026, and we're excited to have Terry Harbort here with us from Talisker Resources. I know, Don, you love this stock and have talked many months about getting Terry on, so we're excited to have him here.
Hello, gentlemen. Thanks very much for having us on and the opportunity to tell the Talisker story.
Yeah,
Yeah,
of
welcome,
course.
Terry. Looking forward to it.
So, Terry, would you be kind enough to give us maybe a 7 to 10 minute overview of Talisker?
Absolutely, gentlemen. Talisker Resources, we're a Canadian-based junior gold producer, listed both on the Toronto Stock Exchange, the TSX, the main board, and the OTC at the moment in the US. We were founded in 2019 as a gold explorer, and we've progressed since then through an extensive drilling campaign, discovery and resource development into being a producer. Our vision as a company is very clear here. We want to develop our flagship asset, the Bralorne Gold Project, into a multi-mine or multi-asset project with the view of producing in excess of 200,000 ounces on an annual basis. Our mission is to achieve that within the next 5 years, and we think we're well on the way here. We started our first development about mid last year, so perfect timing for us. Our first gold sales about August, September of last year, and now we're currently in our ramp up phase at our first mine, the Mustang Gold Mine. We're currently in the planning phases to develop our second mine, the Olympus mine, which is around about 2.5 kilometers from Mustang. We've taken a bit of an innovative approach, so not the general or ordinary path of most Canadian juniors, and that is that we've looked at off-site milling, so a toll milling approach. And really, we've looked at that is how can we get into production fast? How can we get into production requiring a limited amount of capex? So instead of milling, spending $400 or $500 million on a mill, let's utilize facilities around us. And we're fortunate for where we're located. We're in South Central British Columbia, so only about 3.5 hours drive from Vancouver. If any of our viewers are skiers, they'll know Whistler. We're about 2 hours drive from Whistler, so very close to infrastructure. Really located in what is the heart of mining in British Columbia. In fact, in Western Canada. So some of the largest operating gold mines, largest operating copper mines, all within highway driving distance. Many of these were operating at less than full capacity. So we took the tact of, okay, well, instead of going out, building our own mill, spending hundreds of millions of dollars, why don't we try a different approach? Why don't we try to partner with these groups and mill our own material in somebody else's facility, build up a cash pool, build up a cash reserve, and use that to develop our company, to grow organically. And that's what we're in the pathway of right now.
Okay, great. Yeah, that's music to our ears when we hear lower capex. If you remember when Argonaut kicked things off a few years ago, a few Christmases ago, with that huge capex, it really started to scare investors, at least in my world. And we had a lot of higher capexes coming out of COVID in 2021. So now that's still fresh in people's minds. So I like the approach. You had mentioned that you're on the OTC at the moment. Is that to say that you're thinking about uplisting, or are you going to stick with TSKFF?
No, look, I think it's always in the back of our minds of looking at much better access to investors, access to capital. And it's always been very clear to me that historically the TSX and Toronto have always been if you like, the heart of capital generation for miners. But I think we're seeing a significant shift in that now, particularly with the gold price having a sustained level. We're seeing a lot more generalists come across, and there's certainly a lot more retail interest that's US based. So having a parallel listing on one of the main boards in the US is, I think, something that now that we're in a sort of 200 million US market cap range, I think it's a thing that we need to seriously look at. You know, prior to that, when you're smaller, when your share price is lower, I think it's quite challenging. But I think now that we've certainly made that critical mass, it's something that we need to really seriously look at. Not for new investors, but for a lot of our existing investors, particularly institutions, are US based. So I think it's a natural progression in the growth profile of the company.
Yeah, great to hear. You had mentioned that your second project that you're planning is only about 2.5 kilometers away. Um, have you disclosed to the public like how quickly you plan to get that into production?
We haven't as yet, so we're working on the mine plan for the Olympus area, and part of that's actually a resource update. So we're working right now with SGS, who'll be our external qualified qualified or QP qualified professionals about doing a resource update. And also an economic study will probably come out about mid second quarter. We're expecting April. We've got a significant amount of validated historic data that'll be coming into that. We've also got drilling from last year. We've got those results coming in now. A lot of that's resource conversion drilling, so that'll feed into that resource update. And also feed in the economics and the design plan of that second mine. As with Mustang, John, it's pretty close to surface, but it's always good to get a handle on how much development do we need to be able to access the ore, and scheduling the planning of that. So of course, it's always best if we can pay for all that development, pay for resource conversion drilling through our cash flow, avoid having to go to market or minimize what we have to go to market for. So keeping with that pattern of organic growth and sort of not jumping too far out in front of ourselves. So I expect around April we'll have a pretty good plan for that. We've got some preliminary plans, but challenging to talk about that until we've got that signed off by an independent party. But at this stage, looking very good.
That's great. Okay. And last question from my side. I don't think you talked too much about the cap structure and where the bodies are buried, so to speak, in the cap structure. Don and I look for about 30% or more of the shares to be held, by friendly parties. Could you walk us through that a little bit, please?
Oh, absolutely. I'd have to say that we're probably a bit higher than that. I think we're in the sort of 60s of what we call friendlies. So
Wow.
either long-term institutional shareholders, or high net worth, or family office groups who we communicate fairly regularly with. So our split, institutional to retail, is around about 50-50. Most of that institutional is held by strong funds. Franklin Templeton is at about 9.9. Arbiter Partners, a generalist fund out of New York, is at about 9.9, and also the Phoenix Gold Fund out of Singapore, again sitting around that 9.9 group. And then at around the 3 to 5%, we've got a smattering of institutions who've been with us again for the long term, Equinox Partners, Gold 2000 and the Conway Group, US Global, so some good long-term investors in there. And also part of that retail is also some high net worth groups. So fortunate to have the Quaker family office in there as well. So really quite well contained, and about 5 to 6% is insiders, of which myself, I'm sort of the lion's share. This is my retirement fund. So my wife keeps telling me this has got to work well. So that's why we're so focused on it.
No pressure, right? Well, hey, thank you so much, Terry, and I'll turn it over to Don.
This is exciting. Really like the opportunity to talk to you. So for Christmas, I had two Christmas picks, and you were one of them. I mean,
Oh, great.
that's a pretty small group. Coming out of Beaver Creek, you were my number two pick, and it's amazing to me that you remain so cheap. I mean, you mentioned that your goal is to grow organically to 200,000 ounces. It's pretty hard to find another company around the world that can make that statement, especially in good locations, with a good balance sheet, with a pretty good share structure, with insiders. Pretty amazing. You're right now, you have 196 million shares fully diluted, trading at $1.06 US, about 200 million fully diluted. For what you have, I mean, you're really cheap. Your first thing I want to start with your balance sheet. I have you at 25 million in cash and no debt, but that might be wrong. What do you got?
Yeah, yes, in US terms, we're about 25, 26 million. Our debt's currently 1.5 million. That's related to a gold linked note. We'll likely clean that up. We were looking at cleaning that up before the end of the year. We'll likely clean that up so we don't have to deal with any interest payments. We've also got access to a revolving credit facility that's part of our agreement with Ocean Partners. That's for 25 million US again. So sort of access to about 50 million in available working capital if required. We can draw on that anytime. It's revolving, so we can pay it off and draw it back as many times over the next 7 years. The minimum sort of tranche is 5 million, and we sort of have that there, Don, as a backstop, if you like. We've seen too many times over the last 20 or 30 years. Some of the major challenges for junior companies in the startup phase is working capital. Either eating up too much cash from development or drilling or whatever it is, or delayed in payment. So that was one thing that we really wanted to address early. Let's never be in a position where we're forced to go to market because we've run out of money. So at this stage, we're not looking at drawing on that capital. We're sort of keeping that in the background. If we need to accelerate development, accelerate drilling, or if there are challenges that we haven't foreseen, then we can just tap into that credit facility without having to limp to market and say, oh, we've run out of money or we're in these problems. We need to get capital, because really that's something that can destroy your cap structure and also destroy your reputation. So for us, it's all just part of good fiscal management.
Yeah, strong balance sheet in my opinion. I wouldn't call 1.5 million debt. It's like a little hiccup, really.
Oh, sure, but it is still debt, so it's something we will have to deal with. Yeah.
Okay, so the next thing is your resource.
Mm.
Tell us about your resource size and your expectation, because to get to 200,000 ounces a year, you're going to need more than 2 million ounces. So
Absolutely.
What do you got?
So our current resource now is just under 1.7 million ounces, 1.66 million. Much of that was inferred at 6.4 grams per ton, and a small component was indicated at I think it was 9.8 grams per ton, so relatively high grade. The resource update that we have coming up here, probably April or so this year, April, May this year, we're expecting to add about another 800,000 to 1 million ounces onto that resource base, and also increase the amount of indicated. We like to have indicated supporting 3 years of the mine plan out in front of ourselves. So that's what we'll be looking at. As part of that, we're expecting some changes in the grade and in the cutoff. Much of that's related to the implementation of ore sorting technology. We're using a laser-based ore sorting system out of Tomra in Germany. It helps to reduce the waste material. We're expecting to see our waste reduced by between 40 and 50%. And then the impact on our average grade is increasing that grade by sort of 80 to 100%. So it has a double impact on our production scenario.
Amazing. So this year, 2026, how much gold do you think you're going to mine, and do you have an ASIC for that?
I'm a little bit restricted until we get our PA out to talk about total ounces. But roughly this year, we'll be looking at somewhere between the 18 to 22,000 thousand ounces coming this year. Relatively low production rates in the first 6 months. Really, the first 6 months, we're focused on development, we're focused on drilling, we're focused on setting up the framework for accelerated production in 2027 and 2028, which are really our seminal years. We're expecting to see the total ounces increase in 2027 up to about 40,000 ounces, and then up to 2028, we're looking at heading towards just under 100,000 ounces. So really in our pathway, that's halfway in our vision to get to 200,000 ounces. And in the background, we'll also be working on the permitting of our second mine, Olympus, and our mill. We'll be planning on those to come in end of 2028, 2029. So staging each of these in, and then we'll follow a similar ramp up style of 2 to 3 years, and then be reaching that global 100,000 ounces out of those two mines.
So to get to 100,000 ounces, do you have to have your own mill?
No.
Wow, that's fantastic. So, and then you can, as you have that free cash flow, you can build that mill. So you're thinking about building the mill in 28, is that correct?
Yeah, so we're starting to work now, and certainly the economic studies that we're working on now are part of that mill design. So we're doing all feasibility level metallurgical work, rock strength, milling rates, or all of that right now, so we can start to plan this out. We'll have some amendments to our current permit. We'll be looking at increasing the size of the waste storage facility, changing the tailings management. We're currently a wet tail, so in a dam, if you like. We're changing that to a more modern technique called dry stack, which is basically taking a big filter press and squeezing the water out, and you make a mountain or a hill instead of having your water in a lake. So a much more environmentally friendly solution. So we're starting on the design work for those elements right now. We're expecting the permitting process, once we've finished that engineering work, will probably be another 18 months or so. So that fits in quite well with looking at 2028, starting to construct, implement, and have them operating by 2029. And it means that we don't need the capital now, because we'll only be starting that build within a couple of years. So that fits in well with that organic path. We can't really go faster than that. Design, permitting, build, all take the time they take. So I think that fits very well with our current pathway.
How long will it take you to permit the mill?
To permit the mill, the current estimate's between 14 and 18 months. In the beginning of that, of course, is a design phase. So we're expecting a design phase anywhere between 6 to 9 months. So in total, we're probably looking at 2 to 2.5 years.
When are you going to start that?
We've already started.
Okay, so
yeah, already in the design thinking for that. Yeah.
Right. So middle of 28, you could basically begin construction. Best case would be the middle of 28.
Yes, well, we're actually looking that there are some options in BC permitting law to have a pre-permit construction permission. That means that you can start earthworks, you can start building buildings, you can start clearing areas and so forth prior to having the actual permit. So that's part of the pathway, if you like. A similar thing, what we're doing with the ore sorting technology now. So we're starting to build a facility. We'll bring the crushers in, we'll bring the conveyors in. We'll have the facility basically fully implemented by the time the permit's received. So we look at that same approach with our mill. At this stage, we're looking at the optionality of a modular-based milling scenario. So again, we're looking to innovate instead of just following the same path as everyone else. We're looking at, okay, well, can we scale this in? Can we start with a 500 tonne a day mill and then build further on another 500 tonne a day mill and then build an additional mill on top of that? So instead of needing all that right up front, we can stage this across time as we need it.
Right, because you'll be weaning off a toll milling, so you don't have to wean off all of it at once. You can do it in phases, right?
Yes, absolutely. You know that we've got a very good agreement here with Ocean Partners. It gives us flexibility for up to 7 years. The main reason for that, Don, is that things change. If I was able to predict the gold price, I'd be sailing around in my yacht in the Caribbean at the moment, but I'm not. I'm still working. So we have to build in contingencies. And if the gold price goes south, if things change, then it may be better for us to continue toll milling and not to build our own mills. So we need to have that flexibility. If it happens to take longer, we have that flexibility and it won't impact on our operations. We can just keep sending it. We can send it right up to the day that our mill is fully commissioned and fully operational. So I think that's a much better structure. It helps us to avoid the dreaded Lassonde curve through permitting, design, and construction. We can totally avoid that by trucking and processing our ore right up to the day that we flick the switch and turn on our own mill.
Right. So I think when you get into production in 28, I think gold prices, we can be very conservative and use $5,000 gold, which is kind of right probably this year. But I mean, if we use that, if we use 5,000, I mean, which I think is kind of really conservative, I would think the AISC should be around 1,800. Do you think it's going to be much more than that?
No, look, I think if everything goes well, once we have our own mill in and we have and we'll already be using the ore sorting technology, so our milling will be a lot less than we're actually mining. I'd hope it'd be well beyond well underneath that, so come down to 1,500 or lower. We all have to face the inevitable mining inflation of a sustained upmarket. So we need to build in some contingencies for that. So I certainly think 1,800 is a fairly safe place to be.
Yeah, and I think 5,000 is fairly safe too. So in 28, at the end of 28, if you get to your 100,000 ounce target, the margin should be about at least 2,500 is my estimate. So that's $250 million in free cash flow. And you're going to be in Canada. And so Canada is going to get basically a premium to the rest of the world. I've seen that before, US, Australia. You're going to get a good premium for your free cash flow. So if we use a 10, which I think is very conservative, that's 2.5 billion. You're currently at 200 million, and it doesn't look like you're going to dilute very much because you have that revolving credit. You're going to have free cash flow. Your mill's not that expensive. So the upside of your company is pretty amazing. So that's just it. That's just 28. So then you're targeting 200,000 ounces. If you just get to 150,000 ounces at the same margin, the same $2,500 margin, the free cash flow jumps to 375. And again, we're using some conservative numbers here. You use $6,000 gold and it jumps to over 4 billion. So this is my target. So then the value of your company 3.5 to 4 billion. So I see you in a range of 10 bagger to 20 bagger. So your upside is pretty massive if we hit these targets. Of course, you never can assume in mining business, right? So my question to you is your insiders. You said that 60% are friendlies. However, 50% are institutions. And institutions have a really difficult time thinking down the road. They have a really hard time. So if we get to 2028 and they own the stocks today, right? So in 28, you're up to 800 million, maybe more. They're sitting on a three bagger. They're sitting on all that profit, and some guy comes in and offers a 50% premium. Now, they might not be as friendly as me. I'm like, I want that 20 bagger, and they're like, no, we're happy with the four bagger down. We're taking it, right? So, and you might say, oh no, I don't want to sell here. I want this thing's a 20 bagger. What are we doing selling at a four bagger, five bagger? What's So my question back to you is, of those friendlies, how many are really aligned with me and you? Because me and you are like, hey, we're not selling.
Uh, Look, it's a fairly easy answer there, Don, I think. And I can answer it with a couple of points. The first one is any institutional group that's been with us for more than a year has already had a five bagger. And in Canadian terms, we were 32 cents this time last year. And in Canadian terms, we're 150, 154 today. So I think anyone who wanted to take a nice chunk of profit most likely already has. And anyone who's been watching our volumes, we trade between 1.5 and $3 or $4 million worth, Canadian dollars worth of stock a day. So there has been a lot of shifting sands, and I think if people have come that have wanted to take that profit, then they probably have. What I'm confident on is that the main key institutional groups are here because what we're going to build. And they've been here, the majority of them, for a considerable amount of time on what we said we were going to do and what we have delivered. So in the last 5 years, we've drilled 180,000 meters. We've come up with our first resource. We did our permit amendment, finalised our First Nation production agreements, did all of our access development, our portal, and brought the mine into production in 5 years. So what's clear to them is we're a bit of a rarity in the junior mining space. We're a company that delivers on our promises. So they're all fairly confident that the next 5 years, what we're promising them, which will lead to, if we look at multiples or we have a look at your estimate, it'll lead initially to a 2 to 3 billion market cap and then to a 4 to 5 billion market cap. And many of these groups are with us because they believe in the team's ability to execute that. And I've asked my team themselves to commit to 5 years, that we're here to build a mining company, multiple assets. And at this stage, we're looking at 2 mines, but we're thinking of 3, we're thinking of 4. What are we going to do next? Because we're quite different to many companies. We don't have a single solitary asset that we're happy with. We can grow organically without have to do M&A work, without have to take on somebody else's baggage. We can grow that internally. And I think that's really what our long-term shareholders are in this for. Sure, there's always some who take their profits, but I think anyone who was going to take it probably would have taken the 5x that they've just got over the last 12 months.
Well, yeah, so here's the issue. I'm just looking into the fine details, so people that are looking at this stock, looking down the road, is people, it doesn't make sense. If people see what you have, it makes no sense to sell before $800 billion. I mean, that's the way I look at it. But the problem is, see, I want you to get to 4. But what happens is it's really hard for, let's say one of your institutions owns 10%. It's really hard for them to sell. So if a big buyer comes in and says, look, we're going to give you a 40% premium, they're like, okay, now I have an 8-bagger and they're going to give me a 40% premium. I can get this big, huge check. Trust me, they'll take it. So that's the problem, is that liquidity becomes is a big play. It's hard to find 51% of your investors who are literally in it for the long haul. It's really hard. And especially in Canada. So in Canada, it's rare. Up until a couple of years ago, there were no individual single mine mid-tier producers in Canada. I think Blackwater, the Blackwater mine by Artemis Gold was like the first one in a long time, right? And now West Red Lake Gold's trying to get there. And you have New Gold starting, and then you have Next Gold. So they're rare. And the reason why they're rare is because of what I just explained. It's like when somebody comes in and offers a big check, they're like, they because of liquidity issues for these big institutions, you offer them a big check, they'll take it. So Mike, back to you to de-risk your company. I think that it's hard to have a single asset and survive. It's better to have two assets with high insiders. So there's two companies in Canada that are in the similar boat as you, basically uber valuable mid-tier producers. But the other two are developers. But they both have, the reason why they're still alone is because they have really strong insiders. The first one's Next Gold. So Next Gold in your company would be a beautiful fit because you protect each other, and everybody wants to own it, and it just becomes a massive company really fast. The other one that's a beautiful fit is 1911 Gold. They're going to start production here about a year. So that one's a beautiful fit too. And now both of those companies have big insiders, right? So if the thing I like about those combinations is that it's easier to find people that are in it for the long haul when you see a company that's building something, right? It's like, okay, we got two really strong mines. With Next Gold, you have three, right? So you either have two strong mines or three strong mines, and it's like, okay, where's the next mine? Where's the next mine after that? And people are, I'm gonna hold. I'm not selling. This thing's gonna be a monster. So those are two ideas for you to think about. What do you think about those two companies, 1911 and Next Gold? Aren't they a pretty darn good fit?
Sure. Yeah. Look, and obviously, we're always in the process of talking to people, seeing what people are interested in, seeing what their pathways are, and seeing how valuations compare both individually and of a combined entity. We're always looking for a 2 + 2 = 6 instead of a 2 + 2 = 4. Certainly the growth profile of Talisker, timing is the key part. So looking at where do we fit in a jigsaw puzzle, and do our current shareholders come out the other end with the correct valuation that they're looking for. So I certainly like how you think, Don. There's certainly been a lot of great companies built following these pathways. I think from an acquisition pathway, most of the intermediates are asleep. And we've seen that over the last 5 years. There's been very few transactions. The reason most of them are asleep because they're making wads of cash, and a lot of them don't have development teams. They don't have startup teams. They can't do what we're doing because they have operational teams, not build teams. So looking at groups that either are just transitioning into production or are in growth phases, and partnering with groups that are still in those phases that have good development teams is where a lot of value is. And that's how in cycles you see companies like Goldcorp and Agnico grow to massive companies because they have the teams that can execute that growth and that change.
Okay, we're running out of time. I just have one more comment. The only fit that makes sense for your company is because you have strong insiders, there's no reason to give your company away. But the only fit that makes sense is, number one, the other company has to also have big upside. Otherwise, why? And then it has to have strong insiders. You don't want to dilute your insiders. And then number three, it has to be in a good location. If it has those three things, then yeah. If it doesn't, it's like, no, we're not interested, right? Hang up. But I want to thank you for being on the show. It was awesome Thanks so much for sharing this, Terry. Let everybody know the story.
Thanks very much. Appreciate the opportunity.
Yeah, we enjoyed having you, Terry. Thank you, and I'll get to see you in person at my conferences in May. We look forward to hosting you there, and appreciate you coming on the show today.
Fantastic. Some really exciting news coming out between now and then.
Fantastic. So, Don, we don't have too much time here, but can you give us like a 1 minute summary here before we have to run?
Yeah, so it's going to be a bit of a laggard this year. I mean, they're only going to produce 20,000 ounces, and most of it's in the second half. No one's going to really be excited. Once they do the PEA, though, it should start trending. And then as we get into 27, and then investors start looking ahead towards 28, I think in 27 it's going to be a ripper, and then 28 is going to pay off. That's the way I look at this story. But
Yeah.
I'd love to see them merge with Next Gold or 1911. That would be beautiful.
Well, guess what? All three of those companies are attending both of my conferences. So
Oh, good,
at
good.
some
I'll get
point,
talk to each other.
May 17 through 19 in Washington, D.C., or May 20 through 22 in Fort Lauderdale, Florida, we'll get the four of those guys, the three of those guys, and myself together for a drink, and we'll try to broker. No, I'm just kidding. But we'll have a conversation because I think you're right.
Yeah.
Like, Next Gold, you and I have known for a number of years now, and now that they have 7 million ounces of gold and are in the permitting process. I remember the former CEO Jeremy always said, like, "Hey, we have the team to build this. It's not like we're faking it. It's real." And so, like, based on Terry's comments there at the end, he's looking for someone like that that can be complementary. So, yeah, that might be interesting. But I did want to thank everyone for a great 2025. This is our first one of 2026. We plan to bring you many interviews like this. We hope that you'll subscribe to both of our channels. It's fennecconsulting.com to look at our services. And for Don, you can see the website there, goldstockdata.com. Wonderful website for gold and silver stock research. And we'll leave it there. Thanks a lot, Don.
All right.